So from here, what we're expecting is that Bear Stearns is going to continue pushing down. If the market's going to be is going to go bearish, meaning a downtrend, you'll see the market cut through this support area and then come back up. And we see that play out perfectly right here. In fact, on this reversal, remember, anytime you see a big volume spike, you should have a red alert. Look at this, 288 million. Think about this. 1, 2, 3, 4, 5, 6, 7 and 8 months ago, volume was at 23 million. Now it's at 288 million. Okay, a 10-fold increase in volume, and the market has pushed down about $40. Okay, again, anytime you see big spikes in volume, you should be saying alert. Okay, you should be ready for this particular pattern. So again, if the market is bearish, it's going to come in here, retest the support area. It's exactly what it does. Next thing we're going to expect it to do is start to push down. You've either got a short here or a short as the market comes up into the resistance area. Of course, coming into the resistance area, if you're shorting up here, that's a much more aggressive move. So let's go ahead and take a look. You can see the aggressiveness of this trend. Again, this is something that I cover in the quick start videos. When the market is getting into a strong trend, you will see the retracements are very shallow. And look at this. The market could close up here at the 38%. It did manage to push higher, but look at where it closed. Down. It just simply could not get going to the upside. So we had a good push up. The market's continuing to go down. Again, at this point, you've got to be thinking bearish. If you pardon the pun, bearish on Bear Stearns, you've got to be thinking this market is going to be moving down, and at the very least, it's going to be moving down into some of these old 2001 consolidation levels. At the very least, that would be the first stop. So the market, you can see here, boom, pushes down. The next month, pushes through the $100 level, and then that's all she wrote. The market went into a slide, opened up really today. Let's go down to a daily bar. Here's the daily bar, and you can see that over the last several weeks, this thing has just been on a slide to the downside. We'll go ahead and put our lines on here. Back to daily. There we go. So you can see, let's go ahead, let's zoom in here now on the daily. And you can see the volume. In fact, the volume has increased so much in the last couple of days that the February and beginning of March volume, you just can't even read it. So let's go over here. So look at this. The market has been trading. I'm trying to get a read on the average volume here. So on the average volume, looks like around 11 million or so. Anyway, so average volume is staying fairly constant. If you look at this, as we're coming now into the last few waning days of Bear Stearns, and listen, if I sound flip, I apologize. If you were in Bear Stearns, you have my deepest sympathies. But in the last few waning days of Bear Stearns, you can see as it breaks through the lows here on the daily bars, you can see the volume continuing to spike up. If we go back here, as the market breaks down into these lows, you can see the market has a huge volume spike. This again, when you see big volume like this, you've got to be thinking, remember, alert. Okay, huge volume comes in for several days. The market trades into this triangle pattern and manages to break out. The true test is going to be what happens when the market comes back down into here. You can see as the market starts to move up, volume declines as the market's moving up. As price starts going down, volume starts to increase back again, breaking through support, volume staying high, never a good sign. So volume just continues to increase.